A wonderful evening, everyone. Thank you for joining us today. My name is Eamon Gebre, VP of Advisory and Investments at Sarwa, and I'm here joined alongside by Mr. Michael Chu, who is our Head of Investments at Sarwa today. And I want to first start by thanking everyone for making the time this evening. This is a very special webinar for us because not only is our first webinar of the year, but it's also a topic that's very near and dear to every single client of ours that we talk to. It's a consideration that they've been, having probably for the last few years, and it's something that's at top of mind for 2025. Now, I'm waiting for a few more people to come in through the doors. I see the registrations are already quite high, and there's a number of people who are joining us today, and I wanted to say thank you, but I want to give it just a few more seconds for others, so I don't want them to miss some fundamental information. Maybe I'll start, Michael, by maybe asking you, 2025, any New Year's resolutions?
Um, I wouldn't say New Year's resolutions, but I think this year I am determined to cook more. Not dine out as often, control what I'm eating, have more control over the ingredients, and definitely that will hopefully lead into a healthier 2025.
You have a doctor's appointment coming up, don't you? You just want to make sure you're so Let's tell the truth. Um, on
Yes,
my
I don't
end,
want to have to go see a tailor to get my suits adjusted.
a good driver, actually. That's a good motivation. I think mine is a rehash of last year. Just try to be a little bit more active, get some more sun. And really, honestly, I don't know. Just try to not take life so seriously. I think that's probably a good approach in any year, really. Looks like we've got a
Definitely.
good number of people in the webinar now. I think it's a good time to kind of start, Michael. And maybe it's a good place to start. Maybe let's start talking about the agenda that we're going to be covering today. So we're going to be talking about real estate. We're going to drill down into the common reasons as to why we buy property altogether. We're going to try to address the, old age, question of should I rent versus buy, where we're actually going to dive into the numbers themselves to help you make an informed decision. Next, we're going to look at, well, what does it look like should you maybe apply some of this capital towards investing in the stock market? Is it better for you? Is it not as great? And then we're going to dive into what's the most effective approach. And lastly, we have a nice little gift, a calculator that we've built out to help you to come to a conclusion on what's the best approach when you're analyzing a property. If you're deciding to, you have your heart set on a property and you want to buy it, there's a quick and dirty way to be able to decide if it makes financial sense for you. And of course, we'll end it with a Q&A. And I guess without further ado, Michael, shall we?
Let's do it.
Absolutely. Now, it goes without saying, we always start our presentations with a disclaimer, just so we can set the right expectations that we do not have a crystal ball. We cannot tell the future. In fact, a lot of the presentation today was based on historical data. So there's no projection, there's no, I would say bias when it comes to the figures that we're going to be using. We literally just pluck them right out of data that's available to everyone around us. And our views today should not be interpreted as one-on-one financial advice. What I will share is that this presentation was built based on the hundreds, if not of thousands of conversations that we've been having with clients here at Sarwa, and not only at Sarwa, but over our careers, and addressing the pain points that everyone has when they're trying to consider if they're going to buy a property or sell. So if you have that query from a holistic financial planning perspective, please don't hesitate to reach out to us or reach out to your advisor. Now, I want to start. Let's start right at the very beginning. What are the common reasons we buy property? And maybe I should actually rephrase this. What are the common reasons we say we're going to be buying property? More often than not, when you ask someone, they're going to tell you things like, oh, well, it makes financial sense. It allows me to grow equity. I get to benefit from the capital appreciation of when I buy a property. And then, of course, it makes logical sense because why would I rent versus, and why would I rent and pay someone else's mortgage versus maybe just paying myself? It's great for cash flow purposes. I know exactly what my payments are month on month. And also from a diversification perspective, I may already have other things on the go. I want to allocate some capital towards my home. It's a great diversification tool. This is often what we as advisors, and I would say even as colleagues, we hear from colleagues, is what's often touted as their reasons as to why they want to buy a property. But when you scratch at the surface a little bit, and more often than not, when we confide in a loved one or someone who's really close, or maybe when we just reflect upon our personal reasons as to why we want to buy a property, you'll find that emotional bias or emotional reasons are the key drivers as to why we buy property. If any of these words sound familiar, don't worry, don't blame yourself. We're all human here, really, at the end of the day. And there is no right or wrong answer, but it's about identifying what is your driver to help you make the most informed financial decision for yourself. So common emotional reason as to why we buy is I want something that I can call my own. I want a space that's mine. I want something that's comfortable. I want the ability or the freedom to be able to customize my place of residence. I want to be able to renovate, and I can't do that if I rent, or it wouldn't make financial sense for me to rent and renovate my place. I've heard this quite often before as well, too, especially in Dubai, is that, well, I'm buying into a community. This community aligns with my values, and I want to live in that community. So hence, that's my reason as to why I'm buying. I want more control. I don't want to worry about rental increases or potentially a landlord who's not exactly the most responsive when it comes to maintenance issues. I want complete control, stability, the idea of bricks and mortar. This is mine. This is my castle. The last two are interestingly enough, where people may not verbalize this, but status and pride is a key driver as to why we purchase properties. And, Michael and I are from Canada, and Canada has gone through this real estate boom for the last many years. And granted, it's slowed down quite a bit. But there was a time where if you didn't buy a property, we were kind of looked at as a second-class citizen. It's like, oh, you don't have property? Oh, what were you doing with your money? So it became a
You're
point of
not an
status.
adult.
You're not an adult unless you buy your property. And for many adults that I speak to today, even here in the UAE, they feel that a sense of accomplishment is met by purchasing a property. And the last one is pressure. And sometimes it could be family pressure as well, too. It's like, hey, what are you doing? Buy a property. It's what your father did. It's what your grandfather did. This is exactly what you should be doing. Again, there's no right or wrong answers, but it's just about recognizing what is the primary driver that is pushing you in the direction of buying a property. And the purpose of this webinar today is to help you differentiate between the two by helping you see the numbers behind the decisions that you make. So I will jump into that right now, where we have a persona, Jack and Jill. I don't know if that's their real names, but definitely it's going to be their names for today, Jack and Jill. Feel like this is more of a Yahya and Julia, maybe. That's what it looks like to me. Jack and Jill are 38 years old. They're both gainfully employed. They live in Dubai, and combined salary is 50,000 dirhams monthly. And they're currently living in a two-bedroom apartment, and they are paying 140,000 dirhams in rent. They really like the community that they're living in. And the reason why they like it is because it has they have a very active lifestyle, and there's plenty of opportunities within the community for paddle boarding, or whether it be a really nice gym in their building, or they like to run in the community. They like to play squash, yoga. They have a lot of hobbies. They like to go dining out in that community. There's theater, dancing, etc. I don't know where they find the time. I assume they don't have kids, so that will take it with that. They want a place to call their own. They want a place that they can host their friends. They want a place that they can grow into. So they've made a decision to buy, and in this example, within Dubai Marina. Okay. Now they have a budget in mind, and that budget was basically accumulated savings to the tune of 700,000 dirhams. They've been very good savers. They have no debt, really great at budgeting, and they've gotten to the level it's like, hey, we've got quite a bit of lump sum here. We can actually get into the property ladder. And it made sense when they were talking to each other about it. And what made sense to them was, well, very clearly, we're paying 140,000 dirhams in rent. If we were to assume that rent should increase to the tune of 2.5% on average for the next 25 years, the capital outlay would have been to the tune of 4.7 million dirhams. Whereas if we bought an apartment, they saw properties within their budget at 2.4 million dirhams, and just assuming a growth rate of 2.5% over the next 25 years, they would have built up at least about 4.4 million dirhams in equity. So to them, it's a no-brainer. It makes absolute sense. Well, let's dive into how much sense it does make, right? Because one of the factors that unfortunately we don't realize until we actually take that step and commit to it is what the total upfront costs are going to be to acquire property, what the ongoing costs are going to be from a mortgage interest perspective, and what the other ongoing costs, which unfortunately you don't discover until you get your first bill. And that's exactly what we're going to start our conversation with today, is that we're going to dive down into the costs. Now, for those of you who have not purchased a property, some of this information will be really new to you. For those who have owned properties in this region, this is going to be second nature, and you're probably reminded of it every quarter or every month in some cases. But let's start with the very beginning. Purchasing costs. Just like in any other country, when you're buying a property, there are going to be some fees that you're going to incur. Here, specifically, we're talking about Dubai Land Department fee, talk about the trustee fee, mortgage registration fee, assuming, of course, you're mortgaging the property. In this example, in this persona, they have enough to be able to acquire a property through a down payment of 20%, but the rest they have to finance. You have, of course, a real estate agency fee. And in UAE, I would say it's unique to other markets where the buyer is paying the agency fee. Of course, there's a bank mortgage registration fee and a property valuation fee. All in all, assuming you're buying a property at 2.4 million dirhams, when you factor in the DLD fee, registration trustee fee, the mortgage registration fee, et cetera, your capital outlay just in costs are 179,300 dirhams. That is a sunk cost at the very beginning. But your actual cash outlay will be 659,300 dirhams. Why? Because the remaining amount is down payment. So you've got your 20% plus your additional fees, which if we had to put a percentage terms to it, you're roughly looking at about 6.5% on top of your down payment that you need to make sure you have allocated for anything that, for your upfront capital outlay. Okay. Hopefully everybody's with me so far. Great. Upfront costs, 659,300 dirhams is your capital outlay. Upfront cost is 179,300. Let's look at ongoing costs. Mortgage. Now, we have been in a high interest rate environment for the last few years. We're starting to see that come down a bit, not as aggressive as we'd like, of course, but we are starting to see the interest rates are starting to go down. So you're starting to see mortgage providers offering interest rates at a lower amount in response to the Fed reducing the rate. The UAE is, dirham is pegged to the dollar, and there's fair bit of, I would say, what's the right word I'm looking for? Connection essentially to the US market, because we are pegged to the dollar. So whatever happens in the US does happen to us, and with also an applicable margin difference here as well. So what we've done for this exercise is that we've assumed a rate of 3.94%. Was close to middle of the road when it comes to the variance of interest rates that we've seen in the market. And how we came to this decision of 3.94% is that we have seen IBOR, the Emirates Interbank Offer Rate, which is essentially the benchmark rate that banks utilize to decide what interest rate they're going to charge you. That has ranged between 1% to 5.4%. If there were those in the audience today who have purchased properties in circa maybe 2019, 2018, we know that the Emirates Interbank Offer Rate was quite low. So their interest rates were probably just north of 1% or maybe 1.5% or maybe close to 2%, depending on what the banks added on as a margin. But today, it'd be considerably more. If you factor the mortgage interest alone over a span of 25 years, you're looking at total interest costs of 1.1 million dirhams. Okay. And for those in the audience who are doing a running total, hold your breath. There's a little bit more coming, not to scare you off. Let's talk about the ongoing costs. And again, this tends to be a surprise to a number of individuals when they buy property. And unfortunately, sometimes the guidance that you seek is not available, especially when there's such eagerness to sell you a property that unfortunately you don't get the most accurate information. And this is why we wanted to highlight this to you. So when you are buying a property, regardless of whether it's an apartment or whether it's a villa, there are going to be property service fees. And those service fees essentially are paying, if you're in a villa, it's making sure that it's maintaining the community, the landscaping, you name it, anything related to the community is taking care of it. In the case of a building, it's taking care of all operational aspects of the building and maintenance aspects of the building itself. Now, that property service fee can vary depending on the location of the building, who the developer is, and also the number of amenities that building has. Now, in this case, we've isolated specifically Dubai Marina. We know from research that the average cost per square foot is roughly 25 25 dirhams per square foot for the Dubai Marina apartment. So you multiply 25 dirhams per square foot, multiplied by the number of square feet that this property has, you get your cost. And that cost, I'm going to highlight in a bit. We're going to elaborate and we're going to dive into it. But essentially, you're looking at your first year, you're looking at about 32,500 dirhams that you have in expenses when it comes to property service fees. Mortgage life insurance. When you obtain a mortgage in the UAE, life insurance is a mandatory requirement. And sometimes it's lumped into your mortgage as an additional charge, meaning there's no third party or there's no other insurance company that you have to speak with. The bank offers it as a complimentary product. In some cases, you have to obtain independent life insurance. In this case, just for simplicity, we've used the range that banks have when it comes to mortgage life insurance, and that range is typically between 0.02% to 0.07% per month. So we're just right down the middle, 0.04% for illustration purposes. And what that essentially works out to is that your first year, that cost built into your mortgage installment is about 9,216 dirhams. Now, the great thing about mortgage life insurance is that it's based on the value that you have outstanding. So as your value reduces, so does your premium, life insurance premium, right? So you'll see that on the chart in the second column that your year one costs are very different from your year 25 costs. Property insurance, also mandatory requirement. You want to make sure that your property, which is mortgaged, the bank actually wants to ensure that, God forbid, anything should happen to that property, that asset is still going to be available or is still going to be there. And I think the last year or so when we had that flood, I think it was a really good example of the importance of having property insurance. But of course, that has a cost, and that cost increases with inflation. Home maintenance costs, very, very much debated. And when Michael and I were a little bit astounded, but we came to terms with that. But in addition to the property service fees, which is everything outside of your unit, in addition to life insurance, property insurance, we forget sometimes that we upgrade our properties from time to time. Sometimes the toilet won't work. Sometimes the shower won't work. Sometimes the kitchen is not to your desire and you want to change it. More often than not, what people tend to do when it comes to home maintenance costs is they tend to do it in one go, right? So 5 years go by, you've had the same kitchen, same flooring, same everything, and you're like, enough is enough. I want to change some things. I want to freshen up the place, and you throw a whack of money at it. What we did is we just annualized it. And typically, the maintenance costs are estimated to be anywhere between 1% to 5% of the value of a home. And it sounds like an obscene number considering the fact if it's 2.4 million dirhams, if we took 1% as an example, it's about 24,000 dirhams. But have conversations with people who've done renovations in their homes. That a number they'll be happy to pay if that was the only installment that they had to do. Typically, it sometimes goes up to the hundreds of thousands because they want to do a complete refurbish. So what we've done, because we're considering an apartment here, we've gone on the lower end of the scale. 1% is your home maintenance costs, right? Totality basically comes to, sorry, Michael, you want to say something?
Just one point on that, because you're in an apartment, you are also in a shared ownership situation where if something major happens to the building and there are not enough funds in the reserve fund, which most reserve funds are quite unfunded, you as a owner, a unit holder would be responsible for a portion of those maintenance, the service. So let's say the elevators need replacing, or if there's a major structural issue with the building, like external cladding, a leak from the rooftop pool, major things like that, those would fall on unit holders to pay for. So that's kind of how we incorporated that maintenance cost as well.
You do see that sometimes. You said that you get these surprise notifications, your service fees have gone up, they've gone through the approval process through the Dubai Land Department to justify the increase. And so there is some, I would say, audit that does happen, but you're right, these surprises do happen and people don't take that into consideration. But thank you for pointing that out. Needless to say, the ongoing costs work out to be just above 2 million dirhams, which is just shocking to take into consideration because you don't realize it when you're stepping into that arena of buying real estate. So let's put it all together. Let's brass tacks. What does it all mean? You're buying a property at 2.4 million dirhams. You have the benefit of capital appreciation. and it's leveraged capital appreciation because of the fact that you have a mortgage on the property. So it's very exciting, the fact that you borrowed 80%. So you've only put 20% of your own capital into the place, but at the same time, you're getting appreciation on the entire value. So your 2.4 million dirham purchase over the next 25 years has appreciated in value to be to the tune of just under 4.5 million dirhams. You've essentially nearly doubled your your investment value, which gives you a gross benefit of 2 million dirhams, which is brilliant. But let's factor in the costs. What did it cost you to maintain this asset over the years? And I'm not discounting the fact that you had a roof over your head and it's brought you great joy and stability and security. As I said, there is no right or wrong answer. It's about understanding what it means and how it impacts your decisions. The total lifetime costs, the total cost that we just talked about, work out to be 3.3 million dirhams, which means as a net benefit, you're looking at it just objectively, looking at how much did I put in, how much did I purchase, how much did it cost me? This is essentially what the net results are, which means that you're net short 1.3 million dirhams. Now, some might say, okay, well, wait a minute. You've used a growth rate of 2.5%. That doesn't sound right. I mean, surely we've been hearing about the real estate boom that's been happening in the market here. I should expect a higher return than 2.5%. And the answer to that is yes and no. And I'll explain why. There's no need to guess on what the return rates have been on properties. You can actually get them directly from Dubai Land Department. And if you look at the communities here that I've highlighted here, if you look at the properties over the last 10 years, we've plotted for you what the annualized growth rate has been on the price per square footage. So if you were an individual who 10 years ago, Q1 2015, and for those who were here in the market at that point in time, you remember vaguely or maybe not vaguely, but you remember that 2014 was the peak of the real estate market, and it was more or less a deflating balloon over the many, many years afterwards. Many variables that went into to the reason as to why the property market wasn't really that active over the last few years. But nonetheless, this is the data where it shows that if you purchased a property in 2015, Q1, Business Bay, your growth rate in a property in Business Bay, again, average, because there's many different buildings in Business Bay, was just under 1% per year. 1% per year. If you bought downtown, the jewel, the crown of Dubai itself, downtown Dubai had a growth rate of 1.25%. Dubai Marina, 0.56%. JVC, you fared a lot better. Great opportunity if you picked up a property 10 years ago in JVC because it's experienced a considerable boom. But the average growth rate has actually been about 4.34% per year, and followed by Palm Jumeirah. If you average all of these apartment communities here, the average rate has been 2.36%. Where you see the exponential growth that we've all been hearing about is literally the window of the last 5 years, and more specifically post-COVID. For reasons I don't even have to go into, we all know as to why things have gone up. It's because obviously the population increase and et cetera. But Business Bay over the last 5 years has grown by about 4.39% per annum. Downtown has fared very well at 13.44%. JVC has done really well at 16.59% per annum. And this is for the last 5 years. And Palm Jumeirah has benefited significantly from the growth in the real estate market in the last 5 years, where the last 5 years, the average return or average growth in price per square footage has been 19.16%, giving you an annualized average for these communities of 12.12%. Let's do a quick comparison. Just for reference purposes, what has the stock market done for that same time period? If I look at a globally diversified portfolio, and I'm using the MSCI ACRI ETF here, which basically gives you a very good slice of the global market itself, during the last 10 years, the growth rate has been 8.56% per annum. If I looked at the last 5-year average, it's been 13.18%. The S&P, I didn't even want to, if I chose to use S&P 500 as my benchmark, then I already know that this is going to skew the conversation. But at Sarwa, we generally believe that global diversification is the most effective investment strategy. Concentrating all your assets in one market has pros and cons. And in this case, should you have been invested in the S&P 500 for the last 10 years, your annualized return would have been 12.45%. Whereas if it was just the last 5 years, your annualized return has been 16.44%. If you want to get a visual as to what that looks like, and this, for those who've been here in the region, this won't be as a surprise, but this essentially is showing you in a chart form what the Dubai apartment price has been versus the stock market. So if you look back in 2015, you're going to see the communities like Business Bay towards the bottom, kind of, I don't know, not a U, a very flat U, probably the best way I can describe it, a slightly bent, straight rod. Followed by same thing in Marina, JVC, and Palm. But yet you see the two charts at the very top that shows you the S&P 500 and the MSCI ACWI, how they fared relative to the apartment market. And for those who are considering a house, we've got just a chart for you as well too, where you're going to see a very similar trend and probably a little bit more volatility with some of the assets. Take, for example, Palm Jumeirah. From the period of 2015 all the way until about, I'll say 2020, it's been up and down. And there's many reasons as to what caused that up and down. I'll give you a hint on that one. Geopolitical issues that have happened in the region that have caused a inflight of capital and then also a flight out of capital into the region. But nonetheless, we see that the stock markets have fared much better over that period of time, whereas real estate has gone down. And only now, and ask colleagues of yours or people that you come into, for those who've held property for an extended period of time, they're only now getting to the point of neutrality or parity back to where they started and maybe a little bit extra some. Special highlight, though, I will say I will give, special mention to Jumeirah Island, which have, since 2022 have exceedingly exceeded people's expectations, which has been a huge jump. Also followed by, I can't see it here. Where is it, Michael? The orange one is Palm Jumeirah. They've definitely benefited and captured much of that capital coming into the market over the last few years from a villa community perspective.
I think one other thing to highlight, sorry, I mean, on both of those charts is that real estate prices are volatile. A lot of clients or potential investors view real estate as being stable and there's no volatility because it's not tracked on a daily basis. But this is actual sales data taken right from DLD. And you can see that the transactions just show exactly how volatile those prices have been.
Thank you for that, Michael. But there's so much more to cover because this is just one angle of this. What we've done right now, we've just kind of highlighted to you what the costs are. So you take that into consideration if you're buying a property. But there's so many angles to this and so many considerations. It's multifaceted, which we're going to cover. But in summary for this section, growth is often overestimated and costs are often underestimated. Net of all costs, you have to factor in you could potentially be negative. Unless the growth rates are in your favor of the property itself, you may find yourself in a worse off position versus a better off position. More often than not, after, I've been in the region for now, 14 years, and I'm coming to the reality or come to the realization, the same ethos that you have in the stock market does not apply when it comes to real estate. Whereas in the stock market, we always talk about time in the market versus timing the market. The argument is a bit flipped when it comes to real estate, where it's about timing the market versus time in the market. But we'll come back to that in a bit. I do want to hand this over to Mr. Michael Chu. And by the way, folks, there's going to be a Q&A section towards the end of this presentation. And if you don't want to remember your question all the way till the very end, feel free to type it into the chat section, the Q&A section. We will take it up afterwards, okay? Over to you, Michael.
Thanks, Eamon. So what are the options? So a lot of our clients and potential clients always ask, like, well, if I don't buy property, do I just invest? Then what about this wasted rent? Well, let's do that calculation. So we take the same scenario, Jack and Jill. They have that down payment money. They have the money that they would have paid for the purchase expenses. And instead of buying a property, they just decide to put this into a lump sum investment and hold it for 25 years. So this is how it looks like. 25 years at 8.5%, which is in line with MSCI ACWI, a globally diversified equity ETF. In the scenario, we're using the accumulation share class, which reinvests the dividends and already accounts for all the withholding tax and UCITS. So it's withholding tax friendly. The term is 25 years, and we've also accounted for an advisory fee of 0.5% per year. So after 25 years with that lump sum investment, we end up with 4.47 million dirhams at 8.5%, including net of fees. So that's not bad for that lump sum. Now, when we actually look at it, the portfolio value of 4.47 minus your initial investment gives you a gross benefit of 3.8 million dirhams. Now, we have to take out our rental expense. That 25 years of rent have cost us 4.7, almost 4.8 million dirhams. So our net benefit is minus 970,000. We still have to live, but yes, it is not the best situation, but it's not bad.
It's funny because as we were preparing for this presentation, like we've been in the investment space for a number of years, decades actually at this point in time. And we've always known that from a growth perspective, there's no better driver of growth than investing in the stock market. And I would say this is probably the first time that we've done a more comprehensive viewpoint, but I would be lying if I didn't say that we were a bit surprised. It's like, wait a minute, why is my net benefit negative? Well, duh, we have to live somewhere.
Mhm.
I mean, I think
Both
that's
scenarios.
you just can't avoid unless you've got a special arrangement and maybe you're living at home, whatever it might be. And I think there's an argument to say stay at home for as long as you can until you don't lose your sanity. But the idea is there will be some costs one way or another. So whether you buy a property or whether you rent, there will be costs. But
Yep.
what gives you a greater return on investment? Well, in this case, we know that the net benefit is greater than it is purchasing a property. And rough calculations, you're looking about close to 300, like high 300,000 dirhams. I didn't
Yes.
have enough fingers on my hand to do the
Yep.
math.
There we go. It's about 300,000, 400,000. But that goes into the question is which scenario is better? It
Hmm.
seems like they're quite similar.
Hmm. Hmm.
You've got
Well,
a property on one side, and then now you have I guess, investment portfolio that could fund your retirement, but
well,
you've got a fully paid off property. So what are you
mhm.
going to do?
I think the challenge is that it's multifaceted, Michael, right? And while some may value that near 400,000 dirham difference being back in their pocket, whereas some would say it's not that great of a difference for them in order to justify renting for the rest of their life. And I
Hmm.
think this is a good point for us to have the discussions about the different variables and different factors and take into consideration so that at least you're making an informed decision.
Yes.
And one of the things that is, and look, we've got clients from different cross sections. We've got clients who buy, some clients who rent because they're not in a position to be able to buy. We have clients who rent because they've chosen that as an avenue. We have clients who buy who are very happy with their decisions, and the clients who bought who are like, I wish I never made that decision. I wish I just plowed it all into investments, right? So to each his own is the whole idea behind this conversation today. But one of the things that does it is mentioned quite often is that when you're renting, you have flexibility. And that flexibility
Hmm.
is that it's easier to move when your circumstances change. I remember a day in time here where people didn't have job security. And this is several years back where it's like things just keep getting worse and worse. Oil prices keep going down. I don't know what's happening in my company, et cetera, et cetera. And they like the freedom of being able to pick up and go. Whereas if you bought a property, that's a little bit harder to relocate at that point in time. And if you were thinking that you'd be able to sell it, don't forget there is a timeline associated with selling a property. You have to make sure you get the right buyer. You have to make sure the timing is ideal for you. You have to make sure you get the right price as well, because it is an illiquid asset.
Hmm.
Yeah, so I was waiting for you, Michael, to take the next one.
Oh, sorry. I mean, there are a lot of pluses to buying as well. You know, builds equity and wealth. It's a forced savings tool. You have the freedom to renovate, personalize your property. Like you mentioned, it's your castle. It's where you want to come home for. Um, but it's a 25-year commitment usually that anchors you to a certain place. Who knows what's happening with remote work options, flexibility. Having that flexibility now you're committed. You could Airbnb your own home. I personally wouldn't feel comfortable Airbnb my home because that's my stuff. If I was relocating, I'd have probably let it sit empty. So these are options that everyone should consider. It's not, there's, the numbers are the numbers. Like you said, is that 400,000 dirham difference? Does it really make a difference? Or are you going to get 400,000 plus in value by owning your property? And it really depends on individual cases. Now, what it does do, what renting does give us is free cash flow to invest the difference into an asset and investments.
Ah, got you. This is a really great segue for the next section, Michael. So do tell us more about cash flow.
Exactly. Thank you. So we always recommend our clients adhere to a 50-30-20 rule, where 50% of your income is allocated to paying for fixed expenses. The 30% is for discretionary expenses because we do like having fun sometimes, but not too much fun, just 30% fun. And then 20% gets allocated to investing for the long term. So if we take that 10,000 dirhams a month, 20% of your income, and roll that into an SIP, and then I think on the rental side, we do have a cash flow difference. So if we take that as well and add that to an SIP, so this is the cash flow difference. Your total monthly expenses as a homeowner, when we factor in the service fees, the maintenance costs, um, and the insurance, costs you just over 15,000 dirhams a month. But your rental costs, especially in the early years, it's a little bit lower. So 11,667. So there's a difference of 3,900 and change that we should be doing something with. And the best way to actually grow that is to start an SIP with that difference. And then as we go, that difference will change, but at least we're starting with that difference. So as a homeowner, if you stick to the 50-30-20 rule, you're allocating 10,000 dirhams a month and for the next 25 years. And that grows to 9.5 million dirhams. You add that to your home, now you have a net worth of almost 14 million. And even if you deduct all of those housing costs of 3.3 million, you're still left with 10 million dirhams. That's a
Mhm.
pretty healthy account. In net worth terms, and you've got your investment portfolio and your home.
Hmm. So what you're saying here, Michael, is that so assuming that you do decide to buy a property, at the
Hmm.
very least, make a budget to set up a systematic investment plan, an SIP. And that the value of putting an SIP is going to be equating to 9,500, sorry, 9,544,693 dirhams after
Hmm.
25 years by putting 10,000 dirhams away. And they
Yep.
essentially combining this with the value of your home, subtracting your lifetime cost, your overall net worth essentially is going to be
Yep.
10.6. Your gross your net worth is 13 million, but subtract the lifetime cost, your net worth is about
Yep.
10.6 million, you're saying.
Hmm.
What does it
Absolutely.
look like if I don't buy a property, but I allocate not only my lump sum down payment, I allocate the 10,000 dirhams, but also the cost savings between renting or having a mortgage?
Yep. Now here's the scenario. We've taken that lump sum amount that includes the down payment, the closing costs for the property. We've set up an SIP at 10,000 a month, and we were adding that difference between what the homeowner pays per month versus what the rental. And we've made the calculation that after a certain amount of years, the rental cost is higher than the homeowner, so we've stopped that SIP. But this is what it looks like after 25 years. The renter comes out at 16.5 million dirhams, but they've paid 4.7 million in rent. So even after you've deducted all your rent, you're left with 11.75 million dirhams of liquid net worth in an investment account.
Now, of course, this is just an accounting exercise just to show you from a position perspective, but really
Yep.
what you have in hand is a portfolio worth 16 million dirhams, right?
Yep.
And that's the key thing that we wanted to highlight on here. And whereas in the previous case, okay, you've got a portfolio worth 9.5 million dirhams, but you've got an asset which is 4.45,
Hmm.
but you have to liquidate that asset before your net worth is actually 13.9 million dirhams. And
Correct.
liquidating when you get to that stage, and I don't know if if you guys have ever had this conversation with your parents, but my parents are, they're homeowners, mortgage is paid off. They will never leave that home. That
Hmm.
is, despite the great appreciation that they've had in their property. And I kid you not, the same home that they've had since 2007, the same floorboard, the same, main parts of the basement, the same, experience of being cold in that basement and creaky floors. It's exactly the same, but the valuation of that house has skyrocketed over the years. But they will never sell because the
Correct.
trap that they're in is number one, they like their community. They don't want
Hmm.
to. Number two, if they sold, where would they go? If your property value has increased in value, it doesn't happen in a vacuum.
Yep.
All the other properties have also increased in value as well too. So unless you're prepared to make some compromises, which is maybe you'll live further away, or maybe potentially you'll downsize into a smaller home, these are decisions, unfortunately, that you either are going to be forced to make, or sometimes you don't have that option to make at that stage of your life. So
Hmm.
just to kind of highlight that, as kind of the intangibles and the tangibles aspect of things here.
Yep.
But essentially, look, if we're just looking at it from an accounting perspective, just from a number perspective, the difference is quite significant. You're talking to
Yep.
the 1.1 million dirhams is what we're talking about as the difference. So your position net, you are further ahead by
You
rent
are.
and investing.
But but like you kindly highlighted, this is an accounting exercise. Um, your net worth, if you don't liquidate, I mean, if on the homeowner side, you're still sitting at just shy of 14 million, but your investment side is north of 16 million.
Yeah.
So it really depends on how you look at things. And we try to display it as a net just so we're seeing the numbers. But if we view it under a normal lens, that's 16 million versus 14. That's significant.
Now, we have to admit, though, Michael, like no one has the time to do this level of calculation to be able to decide if whether they should buy or not. I mean, let's just say they go to that stage where they've made it to, a priority to make a decision. Oh, sorry, they've made it a point that they've come to terms that they are buying, but they want to analyze the numbers. And this takes quite a bit of research and also takes quite a bit of access to the research and be able to put this together. And sometimes you have to kind of make a decision really quickly. Is there a quick and dirty way to be able to determine if I identify a property, what is it, does it make financial sense for me to buy it?
Mhm. I'm glad you asked. I took the time to build us a calculator. Let me share my screen for you.
Yeah, let me just stop sharing here. All yours, Michael. Please do share with us.
And we will be sharing this with all the registered guests. It just hasn't been prettied up by marketing. I am an investment guy. I live in Excel, but I don't make it that pretty. So, like Eamon alluded, most buyers they forget about the costs. So we tried to build this into a calculator so that buyers, users can understand what it is that we're paying for. So in the example of Jack and Jill, they're looking at this two-bedroom property for 2.4 million. They're currently paying 140,000 in rent. Well, from the calculations of bringing back all the costs associated with owning that property, they're better off renting. I mean, why pay extra expenses? Let the landlord pay for that. Now, the other scenario is, let's say rent is a lot higher. For some reason, they're paying 190. Now it's in a buy scenario. So you're going to be saving, you're going to take a little bit more ownership in that property, but it works out to your favor because now your annual rent is lower than your EMI and running costs. We also have a scenario where some clients may be cash buyers. Most cash buyers, they're looking for a current yield and oh, sorry, net yield, but they sometimes don't calculate the costs associated. So they're saying, oh well, the property generates 6%, should be okay. I only need 4. But in reality, once you bring in the cost, the net yield on that is 3.44%. So these are definitely things to consider as a buyer. Why are you buying that property? Are you buying to live in because you want to feel secure? Or are you trying to buy this and generate income? Really dig down and get into the numbers to really understand what it's going to come out to at the end of the day, the net result.
Amazing. Can we try a scenario if you don't mind, Michael?
Yes.
Can we put in, I'm just going to pick hypothetical numbers here. Let's pick 3.25 as a property purchase. Okay. And
Hmm.
well, let's assume it's a villa. So let's say it's about actually no, yeah, let's do 5 dirhams per square foot. That sounds about right, between 5 and 7 dirhams per square foot. And the area square feet is probably a lot more than 1,300. Probably gonna gather to say 2,200. That sounds about 22,000. Oh, thank you very much.
Yes.
The annual rent on a property like this, and I don't have a reference point to be quite honest with you, but I'm gonna say 285 or something of that sort.
Yeah,
Sounds about right?
probably.
Yeah. Okay. So what is this telling me?
This tells us that the running costs, if you were to mortgage that property and calculate all the ongoing costs, will cost you about 220,000 a year. And if you're renting it for 285, you should probably buy it because you'll save that difference of 65,000.
Ah, I see. Okay. Okay. Very good. Very good. So, and the variables that went into this essentially is the same, scenarios that we looked at. We looked at the property service fees. We looked at
Hmm.
mortgage insurance, property insurance, et cetera, et cetera. We've just basically built it into the deck itself.
Yes.
That's how we came to these numbers. Brilliant. So what we're going to be doing is for all of those who've attended today and also registered and haven't been able to attend, we will send this out in an emailer for you to play around with. For you to kind of try it out, see the different scenarios that you have before you, so that you can decide very quickly, what's the best way to decide, or what best way to proceed if you should buy or not. I think we're on our last slide here, and we're going to open it up to questions and answers. So if I may, I'm going to share my screen. I think I can share my screen again. Let's see. This is always the fun part. You can see
Yep.
my screen, okay? Beautiful. Look, to put it all into perspective, to summarize, what we were talking about today, look, there are many reasons as to why we choose to buy properties. I think the most important thing is to differentiate between emotional variables and financial variables and decide which one is of value to you, and at least be informed, have your eyes open before you decide to proceed. The net benefit that we've seen, from investing your deposit in the market is better than buying in property itself. And this is based on historical returns that we've gone back for the last 10 years. And it's exponentially better if you put an SIP in place. That 1.1 million dirhams will be circa 300 some odd thousand US dollars. That's 300 some odd thousand US dollars that you're further ahead, that you can do quite a bit more. We've done a calculation, buy versus rent calculator, which we're happy to share with you afterwards. And I think in summary, determine your why. I think it's essential to determine your why because it's imperative to your financial health and also personal satisfaction. And on that note, let us please open it up to Q&A, and I will stop sharing so that I don't have to stare at the screen anymore. All righty. Let's see what we can do. I'm going to start with the first one, anonymous, because I just heard about this as well too quite recently. The question was, what are your thoughts on Sheikh Zayed Road landlords having the option to convert from leasehold to freehold? And just for those who may not be aware, there are properties that are leasehold, which means that you don't actually have full ownership, or your ownership is not recognized in the same hold as a freehold property. I'll give you an example. There are communities like Arabian Ranches. These are freehold properties. Whereas you have Green Community West/East, these are leasehold properties where you essentially own the asset that's on top of the land, but you don't own the land beneath it. And there's some, I would say, limitations on what you can and what you can't do, that you have to work cooperatively with those with the lease fees, lessors. Yeah, one of the two. This is interesting because those properties have been there for quite some time. They are properties very iconic. It's to the point that you can actually tell someone where you live by just saying, I live on Sheikh Zayed Road. And Sheikh Zayed Road is a very long road, but when you say I live on Sheikh Zayed Road, everyone knows where you live. That's how
Mm.
iconic and famous they are. I think it's interesting that they're converting them over into freeholds. My question is, what do the numbers say? Because these are older properties. And I'll admit, I just came to learn about this quite recently, but it did intrigue me because I thought that was a very interesting opportunity for those who want to be close to the action and close to, yeah, the action really in summary.
Mhm.
really you have to dive into the numbers. It's an older property. Older properties means that it's going to be higher maintenance costs. Are there going to be more not only service fees but also maintenance costs for you that you have to take into consideration? So it really comes down to it's a number exercise. But location wise, I think it's a spectacular area altogether. Shigside Road is as close as you can get to the action. So I think it's brilliant. Hope that can
Absolutely.
kind of give you a little bit of guidance. I think you probably want to, and by the way, I want to preface all this, Ed, we are not real estate agents. We are financial advisors. We basically advise clients on an objective basis, what the numbers say to help clients
Hmm.
make the most informed decisions. So no bias. I don't care if it's a shack or if it's a 20 million dirham villa. Really, at the end of the day, it's what do the numbers say. But thank
Yep.
you for what do we have?
From another anonymous, they asked how many years is a lifetime? So the lifetime in our example is just the lifetime of the mortgage, 25 years. I mean, your property can last longer than that, but when you get an evaluation report, they usually tell you the building life expectancy of that building. So that
Yeah,
goes to Eamon's point about older buildings you should be careful with because there will be a somewhat of a finite number as a building life, expected life.
brilliant. There's a question here by Anonymous. It said, what if you bought the property and sell it for profit? For example, a under development property, if it's ready. Anonymous, this is goes to the point where it's about timing the market versus time in the market. And that's essentially what, my thesis on this would be that if you are going to get into the real estate game, I don't think it's a great long-term asset to help you generate your net worth. I think that if you're very active and you're familiar with the real estate market and you're comfortable with that level of risk and that activity itself, you can do quite well. There's umpteen stories of people who've done really well. So there's no questioning that, and there's no challenge to that in any shape or form. This is just looking at a typical scenario where we're not all property flippers. We are more or less, I think the majority of the real estate market around the world are people who are buying it because they want it for a long-term stay. But as an investor, if you're looking to buy and flip off plan, oh, there's no question of people who've done well. There's also a number of people who have not done well because they just didn't get the timing right. It didn't work out for them. And
Mhm.
it's not to say it's a judgment on them. It's also just remember there's macroeconomic factors as well too. Market went this way when you were expecting it to this way, as did the developer as well too. So there's no judgment here, but it's about timing the market itself there. What do we got next here? Rent versus buy. Sorry, I'm just going down the list here, Michael.
Yep.
Uh, Rent versus buy. What if you buy and you rent your asset out? The net benefit should factor in the yearly revenues from renting you out. Then essentially you can do an apple-to-apple comparison against the ETF would be more meaningful. So essentially, I think what Anonymous is saying is, man, Anonymous is a very popular name, by the way.
Yep.
But I was just saying that, well, we should, what would the comparison look like if you bought a property and rented it out versus investing in an ETF. And I think we already have the answer to that, which is REITs, really, at the end of the day.
We have
But
REITs.
I'll let you take this one, Michael.
Yeah, I mean, if an investor wants to invest in property, they can buy a property ETF, REITs. I believe we're going to be launching a list of REITs sometime soon. You can get globally diversified U.S. REITs, data centers, residential REITs, and industrial REITs, and that can give you exposure to the real estate market through an ETF.
Absolutely. Well, and let's just say you don't go down the route of a REIT.
Hmm.
Maybe pick up a S&P 500 ETF, or you pick up a globally diversified ETF itself. We saw the historical returns. We know what the cost basis is.
Hmm.
When you buy a property, the rental, unless you get the right price, the rental yield really is at the end of the day is what you're looking for. And there's plenty of websites, by the way, Anonymous, that highlight what the gross rental yield is in many different communities. But many people don't realize that number. It's a very aspirational number until you factor in the expenses themselves.
Yes.
Um, we know of people who have done really well by buying properties at below market price for various reasons and circumstances, but most people tend to buy it at the market price itself. And that
Hmm.
tends to lend itself to the yield that everyone else is essentially getting from that same community as well. But by and large, the yield from a REIT It's probably, and I didn't pick up on that one. It's probably, if not comparable, but probably has done better, factoring in that it's much cheaper to hold on to a REIT. But if you're just looking at for capital growth, I mean, there's no question the stock market has done much better.
Yep. In our scenario, if you had 2.4 million in cash and you were going to buy a property and rent it out versus putting in the stock market will win hands down. And also remember, if you're going to hold this asset, do you want to play landlord for 25 years? Maybe you hire a service maintenance company to deal with. That's an added expense that eats into your yield. And then again, it's an illiquid asset that is here. Yeah, it will appreciate, it should appreciate, but at what levels?
There's a great question here by Lemise. Thank you for sharing your name. How would you rank the stock market versus real estate? Is the objective to generate passive income? Brilliant question, Lemise. And this comes down to really financial planning, really, at the end of the day, because, and I'm going to take a step back. Most of us, if not all in this conversation today, are likely in our growth stage of our financial life cycle, which means that we are earning income, and as time goes by, we're probably going to get salary raises, increments, promotions, et cetera, et cetera, et cetera, over the next multiple decades, which means that you have the opportunity of time ahead of you to be able to grow your wealth by investing. And the primary strategy for people in this stage of their life is more capital appreciation. Dividends are going to be much more of an important variable for you when you get to that stage of your life where you're no longer generating an income because you're no longer working, and now you need to withdraw from your investment to subsidize your day-to-day living. And that's where dividends are going to become a much more important variable for your financial picture. There is no greater driver of growth than the stock market. And even when it comes to income generation or dividends, there are better tools and easier tools to generate the same, if not better yields through stock solutions itself. And I'm going to say stock solution because it can come in many different shapes or forms, but essentially at the end of the day, it's in the markets themselves. But there are easier ways. It's like trying to grab your ear like this by just focusing on one asset class, when it comes to real estate. But there are easier solutions and cheaper solutions, which means that's better yield for you and better outcomes, sustainable income for you. And no tenants that are not going to pay you. So, hey.
Yep.
Are we on time? 6:58. I'm conscious of the fact that we've got so many questions, and I
Yes.
do share. For those whose questions we did not get to, if you did put your name on the Q&A, we will actually have your email address, which will allow us to respond back to you after this webinar itself. So if you did put anonymous on there and you want an answer to your question and we didn't get to you, please restate your question once more and just put your name on there and your email address so that we can get back to you. But maybe we can take about 3 more questions, Michael. You pick.
I think Lucas dropped a question in just asking about investing to rent out. We won't really cover that in this session, but I will try to build it into the calculator that we send out. So they'll give you some kind of framework to understand what that looks like.
Brilliant. What else should we pick up here? Maybe something on a different, because I think there's some repetitive questions here. Can you please share the presentation? I won't consider that a question. Don't worry, you'll get this presentation. Absolutely. You'll get the full video of this. Here's a great one by Shoaib. He said, as an expat, when I retire, I can put my Dubai home on rent. Absolutely. Go back to my home country and buy a home there for much cheaper. So the illiquidity of the home doesn't matter too much. And is this analysis correct? In your case, the way you've highlighted, Shoaib, absolutely. It's a means to an end. I'm assuming here in this case, the property is paid off because you said when I retire, and typically mortgages stop when you retire. They actually calculate it to the point of age of retirement. and that means your property is paid all full itself. And what you're saying is that I'm going to use this asset as a income source to be able to rent, I'm assuming, another property in another country. I mean, that's a great, means to an end, really, Shoaib. As I said, there's no right or wrong answer. Is it the most economical way of doing things to be able to accomplish your goal, right? Or
Hmm.
is there other ways of being able to generate the same level of income at a much cheaper and I would say easier from a maintenance perspective?
Yep.
You don't have to, clean out the sink of your investment portfolio, but when it comes to a property that you own, you're going to be called to, clean out that sink and any other things that are stuck.
Yep. Or the hot water heater bursts and you have to sort that out with maintenance.
Absolutely.
Um, Lynn has a question. Can you explain more how the net benefit in the stock scenario is negative? Given that over the years, a couple is logically making money, increasingly, it's a bit depressing to see both scenarios end up negative. Eamon alluded to that. That was more of an accounting exercise to just show you, try to compare apples to apples. But what really drives that negative figure is that there's hidden costs to home ownership that a lot of clients don't realize until they get into it. Maintenance costs can climb, service charges can increase a lot depending on the age of the building. And then on the rental side, that's your biggest expense. If you're not buying, you're renting. So if you can manage your rental costs, and your stock portfolio will be there. Your property will be there. It's just trying to factor in all the costs to see at the end of the day, after 25 years, you just cash in your chips and you're hopping on a plane. What are you left with if you take into consideration all of the expenses?
I'm going to take this one question, Michael. I'm going to take this as the last one. I think it's a brilliant question. Again,
Okay.
famous name anonymous. The question is, personally, where do you guys stand? Not as Sarwa, but as Eamon and Michael. Renting, owning and happy, owning and wanting to sell. This is a great opportunity for us to share with you our personal. I would start with me. You might have a different experience, but my personal experience, I myself have succumbed to emotional biases.
Mm.
I was the descriptions that I gave you of that pressure, in Canada where, everybody was buying property. I was that person who basically bit. And I was like, yeah, I'm
Mm.
gonna buy. And I've done this a few times. And I've done this a few times. In some scenarios, it's worked out well for me. In some scenarios, it has not worked out well for me that I'm still paying for till today. If you ask me today, I no longer, I would say, respond to that emotional bias. A property no longer fits that requirement for me from a personal fulfillment perspective, from I would say, a sense of home perspective. I am currently renting now, and that's on purpose. Despite as
Hmm.
much as my wife will bother me about, this lovely villa down the street, I said, no, this is a financial decision and it gives us much more flexibility for the future. And that's a decision that I made for myself because I've been there. I've gone through that
Hmm.
multiple times over. And I realized each and every time that was much more costlier than I anticipated. And each and every time there's always some surprises. So if you ask me on a personal basis, and by the way, Sarwa and us, I mean, is almost indistinguishable, I would say, from, Sarwa perspective. We are Sarwa, they are us. So they're all the same. I won't be buying property anymore. I'm still trying to offload the ones that I have.
Mm. Yes. Property owner, a couple times, a few times actually. Canada here, um, currently holding two, wanting to unload one. Went from a two-bedroom apartment in a good area. Um, Wanted that stability. I really liked it. The community is good. JLT, loved it, but we kind of outgrew it. Our building only had one parking spot. We needed two. So we were constantly renting, and that was a big pain. We didn't have the flexibility to make upgrades. And I guess I was thinking down the road, maybe I want to get a Tesla. It's impossible to get a Tesla charger into the underground. So then we're looking at a townhouse. Love the townhouse. It's nice. It's convenient. Two-car garage, a yard, it works, but it's not free. It comes at a cost. And I know the cost. It's not my wealth building tool. It is my castle. I can renovate it, I can do what I like, but it's not going to be my retirement nest egg. I understand that. I look at this as forced savings, kind of like fixed income. It's not going to give me stock market explosive growth, but it's going to be somewhat stable and it's going to be a roof over my head. So that's where I stand. Um, selling will probably sell the apartment because again, before we did this exercise, I ran the numbers and it's 50-50. There's other areas I'd rather deploy capital. Rental yields where they're at, property appreciation where it's at, and then factoring all the costs. I just don't really want to be landlord anymore.
On that note, it's 5 after 7. I do want to let everyone go and have their dinner and spend time with their loved ones. We want to firstly thank you for joining us today. We do appreciate you sticking to the end to be able to allow us to kind of go through all the variables. We wish you a wonderful evening and we look forward to working with you and inviting you to further webinars throughout the year. And thank you for joining us today.
Thank you so much. Have a great night.